Alright guys, welcome back to the channel. Sorry it's taken a little bit longer than expected to record the next video. Currently just doing a bit of travel throughout South America, and this is the first time I've had to sit down and record a video. So as you can see, for the month of April, $266 of dividend income compared to April of last year. This is a 74.04% increase. We had 17 payments across the board, ranging from Genesis down to Newtek, as well as the monthly payers such as Horizon, ACP, and Prospect Capital Corp. So if we look at quickly at our monthly growth before we get into it, we can see that for April, our simple return is still in the negative. We're down negative 8.2%. Our dividend income was actually quite close to what we forecasted at $262. We're just $4 short of that. And for the month being, our portfolio monthly dividend yield is 0.43%, which puts us at a total yield of 5.16%, which is, I think, a bit more conservative and nice to see than that 5.29% we had last month. So currently at the moment, our portfolio value is sitting at 62,000 New Zealand dollars, and that represents a gain compared to last month of 25.6%. So as I said, we had a bunch of payments come through this month, 17 in total. A lot of them are just the monthly payees, which I'll just glance over as a lot hasn't changed, but we also had some new payments from some companies like Genesis and Woolworths. So first and foremost, we had a payment from ACP, who paid us only $1.53, which brings the yearly total paid out by ACP to $6.11. Overall, I still want to sell my position in this company due to their share price taking a tumble, which is something I wouldn't worry about usually, but it seems as they no longer have a strong business moat, and it's looking more and more likely that profits will reduce even more so and place a real strain on the dividend, which is the main reason why I actually decided to invest in this company.
If the dividend does stop, I'll look to settle a loss and then reinvest into a more favourable monthly paying dividend stock such as BST. Next on the list we have AGNC, who paid out $1.88, which brings the yearly total to $7.39. Not much has changed over the past month, apart from signs that their debt has already started to increase compared to what it was in quarter one. The positive for the stock is that it's trading at a 50% discounted rate, but that's only because it's showing signs of weakening as a stock, with its earnings at an all-time low and its dividend not well covered. You could risk it and buy big on a stock and wait for its recovery, but I'm a bit more conservative and will only reinvest the dividend paid out and stay away from adding any additional large amounts of capital to my position. Next on the list is BlackRock Science and Technology Fund. The fund paid out $1.70, which brings the yearly total paid to $6.53. Again, the stock hasn't seen much change compared to last month. However, I have started to try and reinvest the dividends from ACP back into this company, as I believe it's a great conservative backup to the more lucrative Horizon fund, which essentially does the same in what it invests in. Next on the list is ETY, who paid out $2.44, which brings the yearly total to $8.77. Not much has changed since their last payment in March. Their dividend has stayed at 8 New Zealand cents per share, and looks as if May's payment will also remain at the 8-cent threshold mark. I don't plan on adding to my position in this company until I see a drastic change in their return on equity and earnings potential, which at the current point in time is well below the industry standard. The only positive thing is that the company is functioning with a close to zero debt ratio, meaning that they are in a position where they can have cash on hand to offset any losses in the immediate future. Next on the list is KKR Capital Corp. These guys are a business development company which invests in debt securities and offer private credit solutions to private middle market companies. A few things which are great about this company is that it doesn't invest in startups and seeks only to invest in companies with annual revenues between $10 million and $2.5 billion US. This greatly reduces the risk of defaults on its loans through increased guarantees of historical performance from the company and their ability to pay off the loan. Another great thing about this company is that it primarily invests in senior secured debt, which, as I've said before, is some of the best debt to invest in, as in most cases, senior secured debt is debt which will require collateral as part of the loan agreement. Senior debt also uses first liens on pledged assets, which essentially means lenders have first claims to your cash flows before any other debts can be paid, making FSK's interest payments more secure from those which it loans to. For the most recent dividend, which went ex-dividend in March and was paid in April, FSK managed to pay out 6 US cents per share, which for my position came to a total of 80 New Zealand dollars and 69 cents. FSK has an upcoming dividend to be paid out in July of 64 US cents per share, which goes ex-dividend in June. FSK's current dividend payments are well covered by their cash flows. It's good to see that roughly only 66% of earnings are paid out and the remaining 34% is kept for use to pay down debt or invest in other areas for growth. The one unfortunate thing is that their return on equity is well below the industry average by a shocking amount. However, I believe this will change as their management has stated that rising interest rates will positively affect the business net revenue, especially as the companies they loan to will have a lesser rate of defaults due to their financial health. So regardless of the interest rate hikes, FSK's income will rise while remaining just as secure at the same time. Just recently, effects of the Fed interest rate hikes having a positive effect on business have come true, with FSK beating their expected earnings by 3 US cents per share, which has increased their year-over-year income by 15.2%, or the equivalent of $456 million. Overall, I think it's a good time to buy FSK, and I will continue to buy them where I can, as it seems to be trading at a 26% discount. If FSK is as conservative as you'd like, then I'll suggest looking at a similar BDC called Abrdn Capital, which is slightly less turbulent but offers similar results in terms of dividend payouts. Moving on, we have Genesis Energy, who paid out the first of its semi-annual dividend at 12 New Zealand cents per share, which is an increase of 4.7% from its September 2022 payment. As I stated in my last video, during bear markets, we can expect sectors such as consumer staples, healthcare, and energy and utilities to remain pretty steady or drop at a lesser amount compared to other sectors in terms of their market performance. This is due to the essential nature of the product they provide for consumers, regardless of their price. And what I mean by that is that during times of recession, people are restricted to pay for only the essentials such as groceries, healthcare, or utilities. And as Genesis fits into this theme, they'll be able to continue to run a profit even when other companies and other industries such as tech are finding a loss. So Genesis Energy was still able to turn a profit of around 10.34% last year, even though their share price from January 2022 to December 2022 dropped approximately negative 18%. Over the past 2 years, it's dropped closer to negative 33%, which is even more impressive as far as turning a profit go. This drop in share price essentially will erode a company's cash reserves and therefore decrease its ability to use the money to generate a profit and run the business. However, the one silver lining of Genesis is that it's still thought of undervalued, which means that the share price drop could indicate a great time to buy if the estimated fair value of $5.96 holds true in the next 3 to 5 years of growth. Revenue is expected to drop by 4.9% per annum over the next 3 years, but regardless of that, it's still promising that their earnings per share has become more efficient this quarter one compared to quarter one of 2022. If they continue to cut non-essential costs, I think you could see a highly profitable business as the markets start to recover. Some analysts see their earnings growth rate slowing over the next 3 years, which I think is a given for most sectors in this market. However, in Genesis Energy's case, I don't believe that's a reason for concern, as they to date have a solid track record, especially if you look at their historic 5-year growth rates. Next on the list is Horizon Capital Corp, who paid its monthly dividend, which worked out to be a total of 9 New Zealand dollars. Its dividend yield at the time of writing is currently sitting at 10.2% and is paying a dividend per share of 11 US cents, which, as I said last month, is an increase of its DPS from November 22 of 10 US cents per share. Nothing major has changed with the stock from last month apart from a slight price drop, which in my opinion makes the stock even more appealing to purchase if you're looking for a good BDC, which is the possibility to also generate capital gains once it recovers from the current market dip. Our next payment came from the India Fund, who paid 34 New Zealand dollars and 57 cents, bringing the yearly total paid out by IFN to 149 New Zealand dollars and 57 cents. The dividend yield currently sits at 11.4%. This fund dividends are anything but reliable, as you can see with their dividend history. But the attractive part of this is that although the amount paid fluctuates, they have for the past 7 years still been able to pay at least 2 dividends per year, and in a lot of cases a special dividend too, at a rate far greater than the market. Since its inception in 1993, the fund has more or less moved sideways, and over the 30-year period gained 23.14%. As India is still somewhat an emerging market, I'd like to think that the fund will continue to stay true to its goal of exploiting the positive structural changes that will be taking place in the Indian markets, and hence experience large dividend payouts and capital growth in the years to come. In actuality though, this mutual fund is highly unprofitable, hence its sideways stock price. Its return on equity is negative 22.3% compared to the industry average of 16.9%. The equity over the past 7 years has dropped from 807 million to 477 million, which although they have managed to maintain 0% debt, is not a great sign, as it's essentially showing that their profits have been eroding year over year. Even though the dividends are somewhat attractive, it's purely the equivalent of putting makeup on the pig, as their payout ratio cannot be supported by their current profits. Earnings per share is currently negative $3.89, and their dividend per share is $2.04, which means that there is a deficit of $1.85, which needs to be accounted for. If you consider yourself a risk-averse person, I'd stay away from IFN and invest in something different, such as VWO or SCHE, as in the long run, although their dividends are less, you'll probably make up the difference with capital gains, especially as there is a likelihood that IFN may have to cut its dividend to offset its negative earnings per share. Next on the list is JPMorgan Growth and Income. This is a global growth and income pie fund managed by JPMorgan Funds and invests mostly in growth stocks of all market cap sizes, but it's biased towards larger cap. The fund does benchmark itself against the MSCI or countries world index. JPG managed to pay a dividend of $1.80, which was at a yield of 3.58%. or a dividend per share of 0.04 Great British pounds per share. As seen above, there's a slight raise of 0.2% compared to its payment of 0.0424 pounds per share in May 2022. This is not one of my highest paying stocks due to A, the yield being low, and B, my position being quite minute. However, this stock has a great yield for being very conservative, and where you only might expect to see dividend yields between 0.5 to 3% for a stock of this nature. This stock, as I said, has a yield of 3.58%. JPG offers great diversification across a multitude of countries such as Asia's emerging and developing sectors, United States, Japan, UK, and Europe, such as sectors such as healthcare, financial services, industrials, tech, and basic materials, while still be able to guarantee quarterly dividends. It would be nice if they moved a bit more cash to their short-term positions in hopes of being able to snap up any good deals at a moment's notice on discounted stocks, but for the most part, their long and short-term positions are well balanced. Another great thing about the stock is that if you look at their dividend per share, we can see that for the past few years, it's been on an upwards trend, which is always reassuring to see as a dividend investor. Overall, JPG is something which I myself have not invested as much as I should have, and purely from the point of view of wanting to prioritize other funds and companies which I believe would get me to an income goal quicker. I would recommend JPG or JIPI or SCHD to those looking for sure growth and dividends which are more conservative than investing in singular companies. Next payment was from Newtek One, which was founded in 1998. The company itself works solely with small to medium businesses and provides its clients with banking services, business lending, e-commerce solutions, web solutions, cloud computing, and general IT consulting. At the time of writing, their dividend yield is 18.52%, which in my opinion is a yield that they cannot sustain in the current economic context. As you can see, their dividend was already cut in April 2023 from 70 US cents per share to 18 US cents per share, which represents a cut of nearly 75%. What I think is hurting Newtek at the moment is their high rate of debt. Although this benefits part of their business in terms of the money they lend to the customers, the higher than average interest rates are also hurting them on the money that they have borrowed. This debt to equity ratio has nearly doubled over the past 5 years from 77.7% to 143.7%. If they can't get this under control, then their already overpaid dividend will be cut even more, so in hopes of that excess money being used to pay off debt, which is hurting their bottom line and profits. It's not all doom and gloom for Newtek though. The earnings last year ended up being 37.5%, and although this is lower than their 2021 performance of 77.6%, it's a lot higher than the other companies I have in my portfolio. And as their return on equity is estimated to be 33.7%, which is dependent on how much debt they can pay off, this will be a lot higher than the market average of 15.5%. I think it's a bargain with their current price, as some analysts are claiming it's trading for more than a 40% discount below its fair value. I know I did say they are overpaying their dividend at current, but what I think is a driving factor behind that is that their earnings per share is $1.31 and their dividend per share is 72 cents, meaning that there is a certain stability in their payments as long as they can reduce their debt. I wouldn't outright recommend this stock as it's not as conservative as I'd like, but I do think that if we can see a decrease in debt over the next 1 to 2 years, it'll make it even more suitable pick to purchase, as the company itself has a strong balance sheet and a good business moat in my opinion. Next on the list is PGG Wrightson. This is a New Zealand company that was founded in 2005, but it actually has over 170 years experience in the agricultural industry due to forming through the amalgamation of Pine Gold Gaines and Wrightson, which both respectively had been in the industry from 1851 to 1861. The company provides goods and services for the agriculture and horticultural sectors of New Zealand, which is one of New Zealand's biggest industries, generating close to 12% of our GDP and 79% of the primary industry's GDP, which equates to 21.156 billion New Zealand dollars. PGW also paid out the first portion of their semi-annual dividend, which came to a total of 41 New Zealand dollars and 27 cents, represents an 8.94% annual dividend yield. As you can see, they have decreased their payment from when they went ex-dividend in March 2022 by negative 14.3%. Their last year's earning report had them at a net profit margin of only 2.33%, which has slowly decreased about 0.2% each year from 3.1% in December 2021 to its present day value. They have unfortunately needed to take on a bit more debt in the past year, more than doubling their debt to equity ratio from 21.7% to 54%, which has undoubtedly been used to boost the company's revenue by investing into certain areas of the business to boost growth over this period of stagnation. I don't like that they have had to take on more debt, especially with the high interest rates, which will potentially cut into their overall profits. They actually wouldn't be much of an issue for me if their return on equity was substantially high, as it would indicate their ability to remain profitable during this time. However, their return on equity and future return on equity are only just above the market average and dropping, which signifies that they arguably will run into decreasing profit margins across the next few years, which will put a further stress on the company. I also do expect a dividend cut, as they currently are overpaying their dividend with a payout ratio of 92%. I expect they will reduce this by 20 to 30% to keep cash in the business to bolster it during uncertain times. I won't be buying any more of this stock until I see it drop a little bit more in price, as I believe a price change is looming. The business itself is solid, and I think it does have a future, but the next 3 to 5 years might mean that it doesn't turn much of a profit. The good thing is that PGW's balance sheet is reasonably strong, regardless of the increased debt to equity ratio, so it probably has the ability to hunker down and stagnate if markets dictate that is the best course of action to take. Our next payment came from Prospect Capital Corp, who continue to pay their monthly 6 US cent share per dividend, which ended up netting me a total payment of 17 New Zealand dollars and 85 cents. Currently to date, the stock for the year of 2023 has paid me 67 New Zealand dollars and 54 cents. Their price has dropped down to 6 US dollars and 29 cents, which is 10 cents off its lowest 5-year trading price. I intend to buy more of the stock when I have the cash available, as I believe there's a higher chance for investors to return capital gain as well as a dividend if they're able to purchase the stock at that price. Moving on, we had a payment from Restaurant Brands New Zealand. These guys own takeaway brands throughout New Zealand, Australia, California, Hawaii, and Guam. The likes of these restaurants include KFC, Pizza Hut, Carl's Jr., and Taco Bell, and it has been operating as an incorporated entity since 1997. Restaurant Brands has only recently started paying dividends again, as it was initially a company I invested in for growth purposes only during the COVID epidemic, as prices were growing at a discounted rate due to the business being forced to cease major operations through the temporary closure of its brick and mortar stores. Since 2020, they've been able to keep increasing their revenue year over year, which has led them to be able to pay a dividend back to shareholders. Based on their current performance, we could see their return on equity come close to doubling the industry average. The earnings payout is an acceptable threshold, with only 62% of its earnings being paid to shareholders and 38% being retained for growing the company and paying off its current level of debt. This, however, does bring me to my next point. After looking at Abrdn's balance sheet, we can see that their debts, which are due within 12 months and also beyond 12 months, outweigh their current cash stockpile and forecasted earnings outside 12 months. They have approximately 1.09 billion New Zealand dollars worth of liabilities and only 60.1 million New Zealand dollars worth of receivables, which leaves the company in a deficit of 1.029 billion New Zealand dollars. And as their market capitalization is only at 117.2 million New Zealand dollars, it could become a scenario that to raise more capital to pay off its debts, Abrdn may be forced to dilute its shareholders through offering new stock. Another red flag is that Abrdn's earnings before interest and tax was down by 24% last year and has been slowly decreasing since June 2021. This means that they have less free cash flow to use to pay off their debt, which is key to being able to grow their profits. If they cannot continue to grow revenue, which on the other hand is something they have been managing to do, which has been grown from 0.193 billion in June 2021 to 1.298 billion in December 2022. This somewhat leaves us between a rock and a hard place, as it does seem like there is potential for Abrdn to come out of this on top of its debts. However, I still believe it's best to be cautious with this pick and not invest anything more until there are telltale signs of Abrdn measuring to reduce its debt to equity ratio below a point of 50%. As it currently stands, their debt to equity ratio sits at 95.6%. Next on the list, we had another monthly payment from STAG, who managed to pay out 12 US cents per share, which worked out to be 3 New Zealand dollars and 68 cents. This brings the yearly total paid by STAG to 14 New Zealand dollars and 38 cents. Not much has changed over the past month, however their earnings per share estimates have exceeded initial analyst estimates by 22%. Which is music to the ears of shareholders. However, in the same estimate, it calls for net income to decrease by around 20% next year due to higher interest rates now attached to the active mortgages STAG has on its properties. Currently, dividends are still well covered by its earnings. However, this could change if STAG believes it's prudent to reduce the potential net income by decreasing dividends so that it can retain more of its profits. This is something I'm actually happy with, if it means the business can return stronger once the global inflation crisis has become more under control. Price has remained fairly consistent last month, which in my opinion still represents a fair value for what you pay, and I'll continue to buy into my position with any free cash flow I have. Our third to last payment came from Sixth Street Specialty Lending Corp, who paid out $4.65. This brings the yearly total paid by TSLX to $5.58. They have a special dividend scheduled to go ex-dividend next month, which was the second special dividend they will have paid to date this year. Their debt position is still relatively unchanged from last month's commentary, and I'm hopeful they will continue to pay down this debt to increase their 34.3% profit margin by an even greater amount. I'll continue to invest in TSLX for the foreseeable future. Our second to last payment came from Vanguard's VOO S&P 500 index fund. VOO managed to pay a dividend of $1.48, which worked out to be a total of $18.40, which is an increase of dividend per share compared to their Q1 2022 payment of $1.3737 per share. VOO is the largest position in my portfolio, which works out to be a total of $7,500 at the time of recording. Although they currently only offer 1.62% dividend yield, they offer great exposure to the market. So if everyone does well, then you do well and vice versa. As we all know, they've returned an average of 8% annual since 1990. This is actually probably closer to 6% when adjusted for inflation. But with guaranteed returns like that, it makes sense to have an investment like this. It's been estimated that if you invest $27,000 into VOO and contribute $150 per month or $37.5 per week, 40 years, you'll finish with an imbalance of just over $1 million. If we change this and use the annual growth rate of 6% instead of 8% with the same initial investment, after 40 years, you'll have still just over $1 million, but this is in the case that you manage to contribute $400 per month or $50 per week, which for most is more than achievable. If you've been following the market, you would have heard about the recent BRICS agreement. This does pose some concern for me, as if a new currency was established, it would weaken the dollar's dominance and in turn the power US sanctions have over other countries. The decline of the US dollar's value would then leak into the stock market. At this stage, it's too soon to state the effects, so we can't really rush to conclusions. Although if we look at these countries' performance using a MSCI BRIC index, you can see that their performance is well below that of the US. I do think a new currency will have some effect on the US dollar, but as the dollar accounts for 74% of all international trade, 90% of currency exchange, and 100% of all oil trades, and just under 60% of all foreign currency reserves, it might be hard to compete with its deeply rooted international use. Due to this, I'll continue to buy VOO, as the US will remain an economic power for the foreseeable future, and the fund offers an easy, low-risk way of diversifying itself in the US. In saying that though, I do think it's prudent to keep an eye on how this affects the dollar, as we've already been seeing the decline of the dollar's value through the actions of the Fed. Our final payment came from Woolworths. Woolworths is an Australian conglomerate, which is part and parcel owners of supermarket chains across New Zealand and Australia, such as Countdown. They also have a business-to-business segment of the operation, which procures and resells products to other businesses within Australia. Currently in New Zealand, there's a duopoly of supermarket chains made up of Woolworths and Foodstuffs, which means that the two giants in most cases are able to dictate prices to New Zealand customers without the need to compete. This has led to massive profits across the last few years, and although we have seen additions to the marketplace such as Costco or more affordable boutique suppliers, their position in the marketplace is fairly secure, which means they'll be able to continue to take a large portion of the market share during the next 3 years. It's been great to see this consumer staple continues to generate a healthy turnover during this high inflationary environment, and it will continue to do so due to the nature of its business being a consumer staple. Woolworths paid out a dividend of 0.47 Australian dollars per share, which worked out to be a dividend yield of 2.57%. And although it's not the highest yield for a dividend investor, nor present the best case for a steady increase in dividends year over year, the business itself is as close as you can get to a license to print money as far as its New Zealand operations go. As you can see, they did pay a decreased dividend last year, which might have been because their payment previously worked to be 140% payment, which in my opinion is 70% too much of an overpayment, which has definitely put pressure on the company's cash flow. I hate to say it, but I am okay with the cut, as they have managed to increase their earnings per share by 21% over the last 5 years. And so if reducing their DPS allows greater profits and a more sturdy, reliable payment in the future, then I say by all means do so. If you look at their earnings per share growth rate and future return on equity, it leaves you in good stead when you compare it to the current industry and market average. So its earnings dropped off by 0.1 billion Australian dollars at the end of 2021, and the start of 2022 they have since been able to recover and set record company earnings coming in at 1.716 billion Australian dollars for 2022, which is expected to increase to 1.9 billion Australian dollars in 2025. A lot of people have raised concerns over Woolworths' debt, but if we look at it the same way we did with Abrdn, then we can see that Woolworths' current earnings before interest and tax covers its debt interest expenses 14.2 times over. The company also managed to grow its earnings before interest and tax by 282% last year, and has a market cap of 47.6 billion Australian dollars, which is higher than its current sum of liabilities at risk by 22.5 billion Australian dollars. This leaves them in a comfortable position, in my opinion. They are currently using their debt in an efficient way to leverage business growth. A fair value of Woolworths could be seen to be closer to 30 Australian dollars, but with the likelihood of greater profit margin, I'd be happy to pay up to 40 Australian dollars for the stock. I'll continue to DCF into Woolworths whenever I have spare cash.